They say that dollar cost averaging is the best strategy for the average investor to avoid the ups and downs of the market. But are there real dangers hidden behind the curtain? For example, even over 10 years, there are moments where if you'd started investing at the wrong time, you'd still be sitting on a horrific loss of 37% versus what you put in. And that doesn't even account for inflation. I'll show you this a little bit later in the video. However, rather than showing one specific path that just shows how that particular series did at one point in time, we're going to be looking at investing on every single day over a 1, 5, 10 and 20 year time horizon so that you can see the full extent of what all the returns have been for the whole of the history that we have over 37 years. So to understand why sometimes we get these awful situations, we need to look at the strategy. What exactly is dollar cost averaging and how does it work? The way that most people understand this concept is regular investing with your paycheck, usually every month. Each time you receive your money, the portion you can afford to invest gets put into the market, whether it's up or down on a routine basis. This has two benefits. Firstly, it removes the emotion from investing, allowing you to focus on the rest of your life without stressing about market timing. And secondly, it means that you buy fewer shares when the market is high and actually more shares when the market is down. Additionally, because this typically matches a regular investor's cash flow as well, because you're investing out of income from your regular job that you get either weekly or monthly, this also keeps you invested as much as possible. As the old adage goes, time in the market beats timing the market. So the first thing that we need to decide for this study is what asset we're going to invest into. I've chosen the S&P 500 because it is one of the most well-known benchmarks for investing and has done incredibly well over the long run, despite some big downswings as I alluded to earlier. But looking at the index itself doesn't tell the full story. After all, an index is just a number. For the S&P in particular, there are no dividends included into the index, as the S&P is what's known as a price return index. Dividends just disappear. A much better index to use is the S&P Total Return, which includes dividends as well as price. You can see the difference here, which is much more pronounced over the longer time horizons. I'm using Yahoo Finance as it's typically much better than Google Finance as a free data source. So the S&P 500 Total Return wraps up much more of our performance considerations into one place, and although we don't have anywhere near as much data for this as the regular S&P 500, it does go back to 1988, which is fully acceptable for our purposes. With our product now in hand, it doesn't really matter exactly which day you invest on in the long run. But to work out every single period, we're going to have to run the analysis for every single day, or at least starting to invest on every single day of the year. Now, I'm usually a plain Google Sheets kind of guy, but this sort of bigger analysis requires something a little bit more robust. So I wrote some code to make this work so that we can look at every scenario. The principle of the analysis is still pretty straightforward. For each trading day, which is 252 days of the 365 in a real year, because you can't buy at the weekends, we'll use $5 to buy a number of shares based on its price. Once we have a number of shares associated with each day, over a full year, we'll add up the total number that we've bought and multiply it by the final price for that year. This gets you the overall value of our holdings. To get the total return, all we now have to do is divide this ending value by the amount that we put in, which is just $5 times 252 days, or however many days we invested in. If we do that for every day since 1988, we can see every possible outcome of our dollar cost averaging strategy and how it performed. This calculation gives us an average return of 6%, but you can see that the return profile for any individual year is very choppy throughout the 38-year time span. This chart shows how it went starting on any individual day for the past year, and the biggest drawdown is unsurprisingly if you started investing on the 23rd of November 2007, as this was the eve of the global financial crisis, losing 40% of your initial investment in 1 year's time. This is expected for short periods like a year. However, there is an important concept that we'll see emerge here over various time periods, which is that of sequencing risk. The worst time to start investing in a 1 year period is exactly 1 year before the ultimate bottom. This is because if you started investing at any other time, you've still got more capital to deploy later on, and you're not fully invested when a crisis does actually hit. If the crash comes right at the end of your investing period though, as is the case for retirees for example, it can have a disproportionate impact on your overall wealth as you don't benefit from the lower prices because you've stopped buying, and the rest of your portfolio is affected by the decrease in price on your existing investments. Conversely, the best return of any particular year was 26% achieved from the 8th of August 1996 due to a small dip that the index took before marching higher. Overall, on any particular day, you'd have seen a negative return in about 1/4 of the outcomes. This is fairly typical for equity market indices, a positive average return overall, but the extremes are usually much stronger on the negative side than the positive. There's an old adage, rises like a feather, falls like a stone, that quite accurately describes how this works. The issue is, the 1 year time horizons for stocks has never really mattered. Anybody serious about investing for the long term is always investing for over a year. So we're going to have to lengthen out our time horizon to get a more accurate figure for people investing in reality. On a 5-year dollar cost averaging run, we clearly get a much stronger performance because of the extra time in the market, with the average return coming in at 34%. This is roughly 6% a year, so on an annualized basis is the same as the 1 year returns. However, the best performance that we saw over this time period was 108%, starting on the 14th of April 1994, finishing up just before the dot-com crash, and the worst with another harrowing minus 42% loss starting on the 8th of March 2004. It's interesting that the max loss is actually about the same between the two scenarios in percentage terms, but you could easily argue that it's much worse in the 5-year case because of how much longer you'd have been waiting to ultimately get burnt anyway. Again, this minimum corresponds to the high to low of the pre-global financial crisis to afterwards, and cut your capital nearly in half versus what you started with. Even if you weren't retiring in this period, there is a chance that you would have lost your job, which could plausibly have prevented you from benefiting from the low prices too, assuming that you were brave enough to keep going. As expected, investing over a 5-year time horizon reduced our chance of seeing a negative return from 19% to 11%. So with 5 years really being on the borderline for long-term equity investments, let's lengthen ourselves out a little bit further to the 10-year scenario. Here we see an average performance of 76%, with a maximum return of 220%, over doubling your money between July 1989 and 1999, with the max drawdown still in the 40% territory. This was minus 37% from the 3rd of March 1999. At this point, you can probably start to see the pattern repeating itself. The start date spans from March 1999 to March 2009, around the absolute bottom of the crisis. The surprising part here is that even with a 10-year time horizon, the dollar cost averaging strategy doesn't protect you, and you still end up suffering losses of 37%. Many people believe that 10 years is a totally sufficient time for a long-term view on equity markets, and while that is true most of the time, it is easy to forget this dangerous tail that exists for certain events. In this particular study, only 4% of outcomes resulted in a negative return, but those that did can cause truly staggering losses, on average negative 16%. So with the 10-year time horizon also clearly not safe from horrific downturns, can any period of time save us from the market's periodic fits of rage? Well, the 20-year time horizon is where this all changes. Here we see the average performance increase further to 161%, as you would hope, and the maximum from November 2004 at a staggering 329% return. On the downside, however, we no longer see a negative. Our number of outcomes with negative return is actually 0 over a 20-year time horizon, and our maximum worst case scenario has turned into a plus 27%, even if you started at the worst possible time in March 1989. Now you might wonder at this point, given our 20-year time horizon, that we might be getting a bit squeezed for data, and that is kind of true. With a 38-year data set, there are only 17 years where we could actually have invested for this period of time, i.e. through to 2005. However, because we did capture 1989, this meant that we could still fit in the 2008 aftermath into the analysis, and as it shows a positive result even then, albeit a small one given the time taken, we can really start to see the power of the longer time horizon. The overall takeaway from this analysis, other than a better general sense of what outcomes are actually possible over different periods of time, is that sequencing risk is definitely real and should be thought about very carefully, because it's probably more important than the timing of the initial purchases. Although it only becomes a big problem in a small number of scenarios, it can have a dramatic impact on your goals, depending on how long you're investing for, and even 10 years isn't long enough to insulate you fully from the effects of a bad financial storm. This is the reason that, for retirement at least, the generally accepted best practice is to move into lower risk investments. At this stage, it's more about capital preservation than capital growth. But this is still relevant to anyone looking to use their money for other things on shorter time horizons, like purchasing a house or undergoing renovations, as when the market turns, it really can turn. But when the market is volatile, it's very difficult to know what to do. So in this next video, I'll be showing you how to weather the storm and still come out on top.